Let's just get started here. So raise your hand if you can hear me and see me okay, please. We got some hands raised. Thank you, everybody, for that. All right. So we're still, I want to remind you, everybody, that you are being recorded. I hope you're catching the recordings on the website. We go through these webinars. For those of you who are listening on a recording, we're going to have about 15 minutes of updates from the Ed Slott group. I usually read the mailbag, which is questions that come in, and then the Slott updates. We'll do a market update with some analyst reports for about 15 minutes, and a financial planning topic for about another 15 minutes. And that should be indexed on the YouTube video. Right under that, you should see where financial planning kicks in, because some people come just for that financial planning topic. And today's topic is going to be investor behavior. We've talked about this, a little bit here and there over the past few months, maybe a year. But I thought we would just have a little more in-depth conversation about it. Certainly the thing that I talked about last week, which was the statement of financial purpose, that has something to do with it, and we'll revisit that today. But I want to remind everybody that you are muted. There is Q&A at the bottom of the screen. You should have it should be green on your screen, a button. You click in that, you can ask questions. Chat is disabled, and as I said, we are recorded. And we do have lots coming up. Next Wednesday, Sarah Brenner, who is the head of the education for the Ed Slott group, is joining us at 6:30. So you will all be getting invitations likely tomorrow morning, but sometime tomorrow. I wanted to wait until after tonight's class is over. There is a class scheduled starting this evening at 6:30. So I just don't want to confuse people with different things that are going on. But next Wednesday night at 6:30, we'll have Sarah Brenner, and we're going to talk about using IRAs, trusts as beneficiaries of IRAs. So does it make sense? How does it make sense? Who does it make sense for? What to watch out for? How to properly use these things. They can be beneficial, but there are plenty of things that you have to watch out for. The next big event we have planned after Sarah next month is April 27th. Is David McKnight is visiting us here live in Newtown. It's going to be at the Newtown Theater. It's going to be a really, really great event. We're going to have some great food there. Chef Joe Garvey is going to have some food there for us. You folks are going to be invited to a special VIP event an hour before the event. I think it's going to look like 5 to 6, just so you can put it in your calendars, 5 p.m. to 6 p.m. The special VIP event, and then 6:30 for the main event. So come out. We'll have book signings and things like that, and it's going to be I hope it's going to be a lot of fun, and it's going to be great to see Dave and have you all meet him. Let's talk a little bit about, and Dave, let me talk about Dave's podcast. So, I was fortunate enough to be on his last 2 podcasts. He shared the webinar that we did in January, and I heard a lot of great feedback about that from my colleagues and from others around. And I really appreciate Dave sharing that. And I appreciate the conversation. He was so happy with the conversation that we had and the questions we had that he shared it on his podcast. I think that's really neat. And it just goes to show, it's a little bit of a pat on the back for the great work that we're doing and together, right, with this webinar. But this last week's podcast, he talked about some legislation that is proposed by Senator Mitt Romney. Now, Mitt Romney is a little controversial. You might love him, you might hate him, I don't know, but he has this Trust Act. It's called the Trust Act. And what Mitt Romney is proposing is to look at the problems that we have coming up. The Social Security trust going to zero, the Medicare trust going to zero, our infrastructure trust not being funded. So kind of like there was legislation under the first term of the Obama administration. I think it was called Simpson-Bowles, and Simpson-Bowles was designed to look at these problems and come up with a way to solve them. And it was all packaged one together. It was either kind of a pass fail, and it either all went through or it didn't. What Mitt Romney is proposing is that there are several different committees put together, and the committees work on solving the issue for each segment, right? Each issue that's out there And then my understanding is passing legislation separately. So, I'm thinking about, my much smaller scale of getting things done as an elected official for my time on the school board and other boards I've served on. And I wonder if that's the right approach, because I could kind of see that the committees might work. My issue is more important than this issue, and you're vying for kind of the same votes. So it's going to be interesting, but I'm glad that someone with the prominence of Mitt Romney, whether you love him or hate him or are indifferent, is now out there talking about this and promoting these concerns that we all share: higher taxes, the effect of the, what happens when we get to 2 trillion in debt payments, interest payments, and how that's going to affect us as a country. And can we continue to be a superpower with, when we're spending $400 billion in just our debt payments and $700 billion in defense spending? At some point that our debt payments are going to eclipse our defense spending. And what does that mean? How do we continue to pay the debt that we own? So there's just so many questions out there. And so for someone that with Senator Romney's prominence to come out is really great. So I encourage you again to listen to Dave's podcast. He talks a lot about this, and it's really helpful. Our office is open. I've been seeing clients come in. I stopped by there yesterday, very casual. I was I was actually in shorts yesterday and a sweatshirt, but I had to unload some things, and I had one of those pod storage units that is being picked up today. It's been sitting there for the past few months, and I had to load up some returns. So I ran into a client, but I was very casually dressed. That it does happen from time to time, but I gave him a tour of the second floor. So we're just furnishing the second floor now and getting kind of the details together, but the first floor is open. That's where clients really spend their time. So we're excited about that. So we're open for business in an in-person way. So come see us. As I said, our financial planning topic today will be investor behavior, and we'll get into that later. So let's talk about the headlines. So, there's a lot going on, but most of it is, oh, goodness gracious, the market's down. I just happened to look up at CNBC on my screen. The market's down. The futures were up, so I was hoping it was going to be up today. And listen, folks, I feel it too. I want to see positive growth. It's going to be a challenging time. I'm going to digress a little bit. So I in the beginning of the year, I said, I believe it's going to be a very volatile year, and we're going to be up slightly or down slightly, maybe up 5% or down 5%. Well, the market yesterday touched on correction territory, which is 10% or more, right? And I of course didn't consider that when we talked about this in the very beginning of the year, that Russia would invade Ukraine. It feels to me I read about the current ceasefire to allow people to, this isn't about stopping the aggression. It's just allowing civilians to leave the territory that they're then going to go after Russia. But I think what we've gone to is the shock of it, waking up, 2 Thursdays ago, just about, and reading that Russia invaded Ukraine. So there's the shock of that. Oh my goodness, this really is happening. We saw the buildup of it, but everybody hopes that nothing was going to happen about that. But okay, well now we have this happen. Then the shock of it, and kind of the anger of it, the support of around the world from a social media point of view, economic point of view. And now that we're nearly 2 weeks into it, people start wondering, okay, well, now that the shock is wearing off for us who are able to look at it from afar, which is, it's hard. I was talking to a friend of mine last week, and he said, I just feel bad. I feel bad sitting here. We were sitting at our local meeting place that we sometimes go to. And he said, I feel bad sitting here. And when, we're having a beer together and we're talking about things, he's getting a promotion at his police department. And he said, I feel bad. People are there, they're being killed. They're living in terrible conditions, and, just really literally running for their lives. And so there's that guilt, of what can you do? And, fortunate where we live, at least today. So that shock, we're still reeling from that shock, but now we get to the point where, okay, well, how is this going to affect the global economy? How is this going to affect me? How is this going to affect our investments? How is this going to affect my plan? Because we have baby boomers retiring every single day. Many of you are planning on retiring any day, or last year, or 2 years ago, 3 years ago, or maybe 2 years from now, 3 years from now. And this feels like the perfect storm. Well, holy cow, global pandemic. Okay, well, we recovered from that pretty strongly, at least in the beginning. Now we're seeing some shock waves from that, right? We've got 7.5% year over year inflation. Gas is completely out of control. I don't know if you guys go to Costco or not, but I have to go get gas in my Jeep because I'm in a quarter of a tank, and you have to spend time, you have to plan your time, because I know I'm going to be there for a long time, and I'm not going to like the amount that it's going to cost. But I said to my daughter last night, we're fortunate that I don't like paying an extra $25 for a tank of gas or whatever it's going to be. But it's not going to keep me from going to work or going to the store. We're fortunate that I don't like it, but I can pay it. Many people aren't in that situation right now. They're trying to figure out how to pay for their groceries, which are much more. We went to the store last week. 2 bags of groceries was $50. I mean, 2 little plastic bags of groceries, $50. So everything's much more expensive. So as a retiree, I know these things are weighing on your mind. Inflation, what's going to happen with inflation? We get new inflation numbers on Thursday at 8:30. Everyone's very concerned. That's likely going to be close to 8%. Hopefully it's lower than that. Some analysts are saying it could be 10, either this month or next month. We can't look at similar experiences. People say, okay, well, look back, what's going to happen to the economy? Look back at other issues we've had. I don't know if we can ever line it up where we had one country invading another. We have massive inflation, and all of these reopenings and all this other thing. And even if you could find that, lay over instant notification, instant involvement from the internet, the 24-hour news cycle, the social media, right? So this is certainly going to be something to watch, and we have no choice but to watch it and to live it. So this is where investor behavior, and this is why I chose investor behavior today for our planning topic, because it's so important. Because what you do now is going to make a significant difference potentially for the outcome of the rest of your life. And I'm not being dramatic there. So let's see if we have any questions. I know that was a long introduction. No questions. Okay, so let's talk about, let's go through 2 Ed Slott updates. So last week, I told you we got new regulations from the IRS about the Secure Act. And, the IRS did it again. So when the Secure Act first came out, they changed the big thing. That there are a lot of things in the Secure Act, but the big thing was the elimination of stretch IRAs. So stretch IRAs was not, it was never a real term. It was something that we used. That was a phrase that meant if you inherited an IRA, you could use the life expectancy table to take small amounts of it. Well, you could take certain amounts of it over your lifetime as an inherited individual, person inheriting it, and stretch out those payments over your lifetime, therefore stretching out the taxes and stretching out the time that you withdraw it so it has a chance to continue to grow. And when we used to do the math, sometimes it was 3 times the original amount that you were able to get out, especially if you were if you could be tax efficient about it. But and you can't, let me just say, you cannot convert inherited IRAs. I have that question all the time, but you can potentially make them tax free by keeping your other taxable income down. But so in the Secure Act came out and said, well, we're eliminating stretch IRAs. You have to deplete everything by the end of the December 31st of the 10th year after the person you inherited the funds from passed. So everything seemed to be okay. That's a 10-year rule, very similar to the 5-year rule. We'll follow it the same way. And then last year, the IRS had a notice that came out that read that certain eligible designated beneficiaries or non-eligible designated beneficiaries had to take RMDs, required minimum distributions, during that 10-year period. And we said, oh my goodness, What does this mean? And this is another reason why I love the Slott group, because they've got a team of individuals who they read the legislation, look into these things, and report back to us and say, this is what we should be looking at, and this is what's going on. Then the IRS came back. So they said, eliminating RMDs, got to take it all out by the end of the 10th year. Then they came back. Just to recap, then they came in and they said, well, wait a minute, you must take RMDs during that time. Then the IRS came and they said, we were wrong. They issued a notice that said, we were wrong. It's 10 years. Now in the new regulation, they say, well, some people have to take the distributions from years 1 through 9. Those some people are non-eligible designated beneficiaries. So eligible designated beneficiaries who can still do stretch IRAs are surviving spouses, children of the IRA owner or plan participant. IRAs are individual retirement accounts. Plan participants are your 401ks, 403bs. They have different rules. Remember that. So surviving spouses, children of the IRA owner or plan participant who are under age 21, disabled or chronically ill individuals, and anyone not more than 10 years younger than the owner participant. So they are eligible designated beneficiaries. So they can still do the stretch IRA. Non-eligible designated beneficiaries must empty the IRA or plan account by the end of the 10th year following the year the owner or participant died. So prior to the issuance of the new regulations, I just explained it to you. Now they're saying that if you inherit an IRA that is from an IRA owner or a plan participant who had already started their required minimum distribution, so they had already hit the required beginning date. So that RBD, that required beginning date, is April 1st of the year following the year that you turned, right now, 72. Now they're saying if you inherited an IRA or a plan, 401k plan or something like that, from someone who had already taken their distributions, you must continue those required minimum distributions based on your life expectancy from years 1 to 9, and then you must have it emptied by the end of year 10. So thank you, IRS. Thank you for making things even more difficult. So it gets a little more complicated if you inherit it from someone who had to start taking these, at age 70 and a half. So that's before, who was born before July 1st, 1949. Anybody who was born after July 1st, 1949, they fall into the age 72 category for their required beginning date. But it's very confusing. And this just gives another example why you have to work with somebody who is knowledgeable about these things. Again, there's only 400, a few over 400 of us in the entire country who are involved in this Slott group. And unfortunately, the majority of folks who do what I do this isn't even on their radar yet. They won't have it till continuing education, or, it'll be some time. So people are going to make mistakes. All right, so that's the gist of the update from Ian Berger. So Ian joined us a few months ago, but he's referring back to the Secure Act and again the new regulations from the IRS, and they're not likely to back out of these ones because these are regulations that they've sent out. These aren't just notices; these are regulations. So we'll keep you advised if we get any more guidance on this. So Sarah, who's going to be joining us next week, she's writing the Slott report mailbag. So again, the mailbag is when people write in. So I'm going to read these to you. Here's the question, and the question is from, it doesn't tell you. The question is, hello, I was reading the February 28th, 2022 edition of the Slott report and noticed a section titled Beneficiaries Hit with Annual RMDs and the 10-Year Rule. So this is what we were just talking about. It was my understanding that starting January 1st, 2020, most non-spouse beneficiaries would have 10 years from the year of death to distribute the IRA with no RMDs required. Will adult individuals who inherited traditional IRA from an 80-year-old parent in 2020, for example, now have to start taking annual RMDs with the remaining balance withdrawn in the 10th year? And if I remember, I need to go back to 2021 because some people, I'm just going to tell you now, some people didn't take required minimum distributions for 2021 because they thought they were following the right rule with the current the current at the time IRS guidance, where they didn't have to take a required minimum distribution. So one of the questions hanging out there is, now must the people go back and take that required minimum distributions, or is that forgiven because of the conflicting information we got from the IRS? So that's something that's hanging out there. So okay. So this person asks, now, do I have to take these RMDs? So Sarah writes, this is a great question. The IRS just recently released proposed Secure Act regulations. In the regulations, they do take the position that if the IRA owner died on or after his or her required beginning date, then annual RMDs would be required or are required, as well as the Secure Act's 10-year rule. In your example, an adult child who inherits a traditional IRA from a parent who dies at age 80, so they've crossed the required beginning date, right? Whether it was 70 and a half or 72, they're well over that. They would need to take an annual RMD, or this person would need to take an annual RMD from the inherited IRA for years 1 through 9 after the year of death, and also empty the account by the 10th year following the year of death. If the IRA owner dies before his or her required beginning date, then no RMDs would be required during the 10-year payout period. I know we've just talked about this, but can't you see the confusion out there? And do you remember, somebody type in, because I'm sure many of you do, somebody give me the answer to this in the Q&A, but what is the penalty for not taking a required minimum distribution? So not only is it a little confusing, but now, so tell me, what is the penalty for not taking a required minimum distribution? Now we've got two different rules for two different, well, really 3 different classes of people or sets of people: eligible designated beneficiaries, non-eligible designated beneficiaries, eligible designated or non-eligible designated beneficiaries who start taking their RMDs, or inherit their IRA, and the person who they inherited from has not yet reached their required beginning date, or non-eligible designated beneficiaries who inherit an IRA from the person who had begun their required beginning date. So this is just a mess, and it's going to be challenging for people. All right, so 4 people answered. Let's see how many people are right. Ken said 50. I saw you correct it. 50%. Keith says 50% good, and Bill says 50%. You're right. 50% of the amount that you should have taken, which is a lot, folks. There's folks who have $20,000 RMDs, right? So that's 10. Nobody wants to pay $1,000 penalty, much less 10,000. There's people with $100,000 RMDs out there. So good answer, everybody. I appreciate that. Okay, so let's talk about the markets. Ending Friday, the Dow Jones was down another 1.23%. That takes us to 7.15 for the year. Yesterday was horrible. We know that, nearly 800 points down for the Dow. So year to date on Friday was 7.15%. Year to date for negative 7.15. Year to date for the S&P 500 was 8.94. Last week was 1.24. The NASDAQ is down nearly 15% so far this year. The global index, stock index is down over 11%. Some of the smaller countries are down over 12%. The world's small companies is down over almost 11%. So it's none of the stock market looks good for this year. Don't be pessimistic about that, though. The challenging thing for many people is the bond market's also down. So the most common bond index that we use, right? So is the Barclays aggregate index. That's down 3%. So that's a lot less than some of the ones that I told you in the stock market, but they were running pretty even for some time. And in fact, the aggregate bond index was up almost 1% last week. So that's good. The 1 to 3 year index was up 0.15. So maybe we're starting to see some stability in the bond markets. That would be good. So, this is all very challenging right now. The question is, how long is it going to last? BlackRock, I'll give you some of the key points just from BlackRock. They said, we see developed market government bonds, right? So that includes U.S. bonds, as ineffective portfolio diversifiers and then favor inflation-linked bonds in this inflationary environment. And They went on to say that they're underweighting now bonds. Again, this is a tactical manager, underweighting bonds, overweighting stock. That's their move. I'm not recommending that you do that. I'm just telling you where they are. Energy prices surged, as we all know. Equities at stocks, they slid with Europe, hit harder than the U.S. bond yields fell and reduced rate hike expectations. So what they mean by that is they're expecting, because of all the trouble with the stock market and the global issues out there, is that perhaps the Fed doesn't increase rates as aggressively as maybe they thought they would. So yet to be seen. We're very, very close to the first discussion about rate increases. Not discussion, implementation. So the week ahead, the European Central Bank will likely emphasize the need to assess how much higher energy prices, how higher energy prices will hurt activity, suggesting less for it to do to normalize policy. So there's a breaking point that people theorize often, and many people say it's $200 a barrel for oil, and that probably equates to $7 or $8 a gallon, depending on type of gas. I think it's probably much lower than that. And so what happens is when you get to be those levels, then you're going to see people driving less and doing things. So demand will go down, and maybe we'll have some balance there. But again, it's different. The majority of people out there are not as fortunate as many of us, where we don't like to pay for this, but we can deal with it. Now, again, if you're rolling into retirement, it can be very, very challenging, because you're thinking, is this how it's going to be? Because it's not just about driving your car and making those choices. It's about the cost of fuel to get things to us. And that's one of the reasons we're seeing the costs of everything increase. Okay, so limited discussion today around the market and activity. We talked about activity. We had BlackRock's view. I'm going to move on to financial planning for the sake of time. So I'm going to share my screen here. Let me just see if we have any questions. All right, I'm going to share my whiteboard here, and then everybody just raise your hand if you see my whiteboard, and it should say financial planning topic, investor behavior. Now, interestingly enough, going back to 2012, I guess it was, or 2013, is that right? Yeah, I guess 2013, when I was first considering getting on the school board, my decision point was I was looking at master's programs focused on investor behavior, because this has always been fascinating to me. Investor behavior, always been fascinating. The idea that someone can hire someone like myself, spend the time and effort to go through financial plans and have everything mapped out, and then act opposite of the direction, whether it's just not taking general advice, doing the opposite of that advice, or being frozen in place. So, and I've witnessed all of it. I'm thinking of one client in particular who, when we were doing the segmentation, they were responsible for a portion of their first segment one, which is a critical segment. We had to take an aggressive portfolio that they managed and take it to a conservative portfolio, and that never happened. So that's going to affect them in this segment. And there's a few examples of that. So that the investor behavior is really interesting. And I cited a couple of things here that you can see. Now I'm looking down because I'm looking at my whiteboard. Now you see here, this is one of my favorite, and anybody can access this. Seeking Alpha is one of my favorite resources for many things. And you can buy subscriptions to it, but you can also have a free access to it. This is one of the great articles I found on investor behavior and investor psychology. And let me just give you, of course, investor behavior is what do we do in certain circumstances, whether it's, your investments have performed really well, and we know that we should take distributions out of those investments, and you get stuck on paying capital gains. Well, I don't want to pay capital gains. Well, that's okay. I mean, that's something to consider. We have to take money out of portfolios from time to time, and certainly when you're in retirement and you're starting to spend your money. And the cost of many of those things is capital gains if you haven't set yourself up for tax-free withdrawals. And many, many people come to me and they're not there yet. So part of the process is, paying for that tax now, so you don't have to pay for it later when they're going to be much higher. We see it with Roth conversions. Many of the folks who come to us say, and this is part of investor behavior. It may not be about what holdings you have, but it certainly is. I know we're supposed to convert $200,000 this year, Mark, to Roth IRAs, and I know that taxes are going to be higher in the future, and I don't know how they won't be, but how do we? I can't do it. I can't pull the trigger on that, right? I can't. I know I should pay the tax, but I can't pay the tax. So why don't we do $100,000 this year, and then we'll see what we can do next year. And then always what happens is they say, oh, geez, now we got to hurry up and get this done. I've never had a circumstance where a client in years 2, 3, 4 has said, well, geez, I think we should keep with this slower pace. It's that comfort. And that's investor behavior. And psychology plays a key role for sure in this. Emotions, it's easy for me, it's easy for any investment professional to look at your situation and say, or it should be, and say practically and mathematically, this is what you should do based on our training and experience. That's one of the reasons folks hire us, because we take the emotion out of it. Doesn't mean I'm emotionless. Listen, I see the markets, and of course I'm worried about my own investments, but I'm mostly worried about yours, right? I think about yours. You folks are the ones who keep me up at night thinking about, well, what should we be doing? And, and how should we be doing this differently? And we have to constantly be evolving, not being capricious about our choices, but we always have to be looking for, other opportunities. But you folks, that should be part of the relationship also, is let us do the worrying, and so you can enjoy yourself. But psychology certainly plays a key role. There's a lot of feelings, and you folks may not know this or remember, but when I didn't finish college until I was nearly 30 years old. I was in the service, and I took some class. But anyway, it was just always something I wanted to do, but just finished my degree. But and I'll come back to the master's discussion. But my degree is in psychology and English. So it's not finance, it's not math, it's psychology and English. The rest of it I had to learn, as I went, which I think has worked out well. But the psychology is very important, very interesting and very important, because there's a lot of feelings behind money, and you see it with couples, you see it with individuals, and it's something we have to constantly work with. Back to the master's that I was considering doing when I instead spent all my time on the school board. I wanted to find a master's in behavioral psychology because it was so interesting to me. And I at the time, there really wasn't anything out there. And this only goes back 9 years, I guess. Now there's many, many programs. It's just not my window right now. It's my kids' window to spend money on college, not me. I actually looked at going back to the school I graduated from, Lesley University in Cambridge, Massachusetts, because they would have allowed me to build a program for a master's program in behavior, or master's in behavioral psychology, maybe one day after my kids are out of school. But anyway, certainly emotions. You've got to construct a portfolio that meets your investing goals. We're going to come back to this, and you can only benefit from comparing your profile, right? So your goals to investing strategy. This is interesting. So this is from Forbes. This is a really common example of investor behavior and market action, or market activity, or market behavior, let's just call it. So I'll let you read this along with me. But Peter Lynch, who formerly managed the high-flying Fidelity Magellan Fund from 1977 to 1990, you have to admit there were some challenging times, late 70s until the early 90s. Peter Lynch is a legendary investor. Under his management, the fund averaged an astounding annual average return of 29%. It would seem all you had to do was ride along with Lynch, and you would earn phenomenal returns. But that didn't happen. There's lots of, you can Google this Peter Lynch investor returns, Fidelity Magellan Fund, and you have lots of articles. This was from 2021. And I just like this one the best. There's Morningstar has a lot of great information about behavioral investor behavior, but it's a little more clinical. Not really clinical, but it's I don't know, it's just not as interesting. But that didn't happen. According to Fidelity Investments, the average Magellan Fund investor lost money during that time. Now, I remember this discussion being the average investor earned something like 3 to 4%, but they're saying they lost money. And that's from Fidelity. That might be an extreme example of what plagues individual investors, but it is highly illustrative of investors' behavioral challenges. And then it goes on to these Dalbar studies that we're very familiar with. So it shows that the average equity fund, so that's stock, so that's, just read that as stock, fund investor underperformed the stock market as represented by the S&P 500 by nearly 1.5% over 20 years. That's less than I thought it would be. Through 2020, the annualized S&P 500 return during that time was 7.43. So the market itself over that time averaged 7.43%, but the average investor did 5.96%. So you might think that's a pretty small gap, but that can be significant as an average. And it just shows the difference. So rather than staying invested, this is huge. This one's huge, right? Average of 29%. And then the average investor lost money. So how do we overcome this in the time that we have left? How do we manage investor behavior? Bring this down. So my words aren't going to surprise you. This is just bringing you back to the fundamentals. Be sure you have a plan. Be sure your plan is a real financial plan. Now, I went through a lot of training through my time at UBS, Payne Weber, Wachovia, Wells Fargo, through that first decade of my time in this business. And planning was not really done. The planning tools that they used were really just a means to bring in funds to the firm. Because that's what these big, listen, this is how we earn our living, right? And there's a certain point where you've got to stop bringing in new clients, or you've got to continue to grow your firm. But that's it from someone my size, but not from a Wells Fargo, UBS point of view, Merrill Lynch, whomever. They constantly want more and more and more clients and money. So these tools are geared in that direction, not really geared to dig in and find what you need, what potential outcomes are, where your issues lie. So you have to make sure you're having an actual financial plan built around it. The planning work we do now is just light years beyond the tools and the process we had at the big firms. So be sure you have a plan, and of course, be sure you review that plan, right? So we should be doing the financial planning process. How often? At least every year, right? Well, let me just say every year. We shouldn't be remaking the plan within the year unless there's some significant reason to do it. You've got to be clear on what your vision is. So what is your vision for retirement? We talk about this in the Changing World of Retirement class. But going back to when things are troubling you from an investment point of view, market's down. Let's go out down. Your market is down. Let's do this in red. The market equals negative 10%. Maybe your average investments are down 5, let's just say, negative 5%. This could be troublesome. If you look at everything as a whole, maybe you're down 5%. But so this could be troublesome. Well, geez, what does that mean, Mark? I mean, if I got $1 million, it's down $50,000. That's a lot. If I'm riding here, I'm down $100,000. That's a lot. So how do you overcome the desire to say, oh, geez, let's just grab it and stay on the sidelines, until this washes out? Because we know historically that kind of timing doesn't work out. It doesn't mean you should do nothing. You just know that kind of timing doesn't work out for very, very few people. So when this is happening, you've got to revert back to your vision. Okay, what am I doing? What do I want to do during retirement? I've got to set that target. Last week, we talked about your, let's make these green because they're positive, your statement of financial purpose. I'll just make that green. Your statement of financial purpose. Remember, I shared mine. I wrote it down here. I keep it on my desk. Really simple: to live freely without financial concern, to spend time with my family and friends doing fun things, to help my children achieve their dreams and goals. Really, really simple. Okay, well, if that's that's your why. Why am I doing this? Okay, does it really matter what's happening in the markets now? Will this affect my statement of financial purpose? Maybe, but for me, no, because it doesn't matter what the market's doing now. If I was 10 years older, more than that, almost 20 years older and retired, perhaps it would. So I'd have to focus through that. And of course, your goals. What are your goals, and where are you in your funds in relation to your goals? And I want to come back to that. So I hope that all makes sense, because these are the things to help you manage the concerns that you have now and allow you not to, I hate to use the word overreact, but I can't, it would just react, because you don't want to react. There's nothing wrong with taking a look at things, analyzing things, getting comfortable, reassessing. You just don't want to react. So number 2, review your plan and investment strategy. So, we should be doing this, every year. Investment strategy, we're reviewing this on an ongoing basis. We like to say that review the investments on a quarterly basis, but, we do it almost on an ongoing basis. So I have to tell you, we are laying out some exciting changes coming as far as our portfolio structure. And it has to do with this transition to Schwab has opened up, not really, I guess we had access to the same investments, but it just feels easier, right? It's just as far as being able to get things done. So we're very excited about it. So review your plan and your investment strategy. So remember the 3 pillars here. So you've got asset allocation. You've got to focus on the types and area of investment. So many people are saying, one of the things that I was reading is that people are dumping Russia altogether, right? Russia ETFs out the window. I mean, if you want to do that I'm standing my ground against this invasion point of view, that's one thing. And I commend that if that's what you want to do. From a investment point of view, it may not be the right thing. That goes back to timing. But from a, fundamental, this is where I stand, I just don't want to support that, then again, I can understand it. But you want to focus on types and areas of investment. What do I mean by that? That just means your pie chart, where things are. You've got your stock holdings, right? And within stock holdings, you've got your large companies, growth, large company value. You've got your mid-size, so you got your mid-growth, mid-value. You've got smalls, you got bonds, oops, there's my calendar. You have bonds, you have real estate, you've got all these exposures. So pay attention to the types of investments and the areas of investment. So this is the areas. Types would be, do I utilize ETFs, right, that just track an index? Do I use mutual funds? Do I use individual stocks, individual bonds? So what you're investing, so the areas and types, pay attention to that. Costs are very important. We use a lot of ETFs because they're super low cost. So we like to use, for example, Vanguard. We use others too, but I think the S&P 500 Vanguard is 0.3%. It might even be less than that now, 0.03%, excuse me. Super duper low in cost. And if there's no added benefit to hiring a fund manager or an individual investment manager, then this can be a good way to go. So pay attention to the types and areas of investments and the costs. Nearly everybody who invests with us has some form of principal protection strategy. If you can't see the value of a principal protection strategy right now, I don't know what is going on. So we simply look at, well, here's your total portfolio. I'm going to use the $1 million example again. Studies have shown, and there was a BlackRock study that was really, really great, that if you take a third of this, so just call it 33.33 or $30,000 and you put it into something, and right now I use fixed indexed annuities. You put it into something that has zero potential for, or the worst year you can have is zero, and you could earn an average of say 3 to 5% on average, maybe call it 3 to 4 bond-like returns, but no risk. Now some bonds are down. We heard the Barclays were going to make this red, right? So some bond, the index or funds, Barclays is down. What did I say? 3+% negative, right? Some bond funds are down 5%. That's negative. That's down 7%, some bond funds. So if you're getting bond-like returns on something that can't go zero, isn't that better? Well, the answer is yes, because even if, you said, well, last year I did 7% in my bond portfolio and I would have only done 3 to 4, but you're in this example using principal protection, you're never digging out of that hole. The worst you do is that zero. And in fact, every year you kind of reset that, that gain that you have, potentially. So, but the worst you can have is a zero return. So as you grow this, even if it's modest, it's amazing what happens. And going back to investor behavior, this helps dramatically. And it helps, instead of, if your bonds are down and your stocks are down, to have a portion that hasn't moved and can do, the worst it can do is zero, can just save your whole strategy and plan, because you say, okay, all right, it's not as bad as I thought it was going to be. And we've got this part here that's really helped keeping things afloat. And even in modest, or regular markets, these help. This allocation, what BlackRock's shown, this principal protection has, it helps increase the overall return of the entire portfolio. Now, if we do nothing but fly and we have great returns for the next decade, then you're not going to see as much value out of the principal protection. But if it's negative or a normal market, you're going to see significant difference. So account segmentation, coming back up here. Can't say enough about that. And you folks that are clients of ours that we've done account segmentation for, and that should be everybody, who's at least through the process. That's where we develop your timeline, right? And we determine how much you're going to need in each segment. So 0 to 3 years, you've all seen this a million times, probably, 7 to 9 years, 10 to 13 years, and 13 plus years. So the money that you need today should be more conservative, right? So you won't see wild swings in this on the up or the down. The money that you need in future years gets more aggressive, right? So this will swing a little bit more from 4 to 6, right? But you don't need that for 3 years. This will be more aggressive, right? This might be a +6, -6. You remember these numbers. Let's just call that -10. Let's give it a shock value there, -10. But you won't need this money until years 7 through 9, and then you can be nice and aggressive here. And this is where you see, the average +10, -15, for example. But we won't listen if all your risk is being taken, the majority of your risk is being taken in years 10 plus. Then that's not going to keep you up at night as much. Doesn't keep me up as much, right? Thinking about your portfolios. So that's how you overcome this. When you have these plans in place, you review your plan. All right, I get it. I know my goals. Work on your statement of financial purpose. I know my vision. I know where things come together. And I know that, I'd like to buy that place in Florida, or I'd like to do this. And I've got that money set aside here. So the markets aren't really affecting me. And I'm going to review this plan to make sure that it's not, I don't know why I circled that. Let me take that away. I'm going to review this plan to make sure that it's not greatly affected. Now, I'll tell you, we raised our inflation to be about 3.5%, and that greatly affected some plans. And we have to go through and rework these plans, for our clients, with our clients, to make sure that everything is continuing to work. But you've got to revert back to these strategies. Be sure you have a plan, review that plan and investment strategy, and take advantage of what we're doing for you: the asset allocation, the principal protection, the account segmentation. And if you can lay on top of that guaranteed income, some form of guaranteed income in addition to Social Security, in addition to any kind of pension, then you've got a really, really strong foundation that should help eliminate that worry, right? Because this is where the worry usually lies. And for many of you, unfortunately, you're right here in the 0 to 3. You've either just retired or a few years into it, and now you're like, geez, Louise, global pandemic, out of control inflation, and now Russia invades Ukraine. What the heck is going on? So the hope is that all those things help eliminate that worry. We're going to back that out. I'm not getting a lot of discussion here about the FOMO, right? You heard me talk about this as fear of missing out. Because when the markets are flying, not a lot of people were worried, although some people were. Actually, a lot of you still were. But there's also this part. Wow, wait a minute. If I would have invested in this, and that, or my brother, cousin, plumber, uncle told me I should have invested in this, I would have done much better. But these allocations here help us have the growth. So segmentation is huge. And that's a constant process. We're setting up right now our new trading and rebalancing platform, which is really intense. It takes a lot of time. So I hope that's helpful. It's a little over 10:45. So we're well within our time. Let me just see if there's any questions. No questions. Okay, folks, I hope that was helpful. For those of you that are on our class tonight, we'll see you tonight. Next week, we have Sarah Brenner, but we're going to see you again on Tuesday. If you're a client and you need to see us, you have questions, you want to schedule a review, call us. The calendar is very full, but we'll certainly make time for you, even just for a simple conversation. And otherwise, I hope you're all well, and we'll talk to you soon. Take care. Bye-bye.